I imagine it's a normal morning and you step outside expecting your day to follow the same predictable routine you have lived for years, where money flows quietly through your daily actions without demanding much attention from you. You walk into a nearby shop, pick up a few basic items, and when you try to pay with cash, the shopkeeper looks at you and calmly says that cash is no longer accepted anywhere in the system starting today. At first, it feels like confusion rather than fear, because your wallet is still full, your money is still physically there, and nothing about it looks different from yesterday. But within minutes, as you move from one place to another and hear the same response repeated again and again, a realization begins to form that something fundamental has changed. You are not being denied goods, you are being denied the ability to exchange what you thought was money for those goods, and that difference changes everything. Because money is not defined by what it looks like or how it feels in your hand. It is defined by whether the system accepts it as a valid medium of exchange. And the moment that acceptance disappears, the paper in your pocket becomes something else entirely, something that holds no functional power in your daily life. That is the moment when money stops being personal and becomes purely systemic, existing only within the structure that allows it to move. This is not a dramatic collapse. There are no riots in the streets, no immediate chaos, just a quiet shift that most people are not prepared to understand, and that is exactly what makes it dangerous, because it does not feel like a crisis until it has already begun to affect every decision you make. On Economic Chronicles, we break down how money actually works behind the system. Not what you are told, but what is really happening beneath the surface of everyday financial life. Because once you begin to see these patterns clearly, you stop reacting to situations emotionally and start understanding the structure that shapes every outcome. This is not about quick fixes or surface-level advice. This is about seeing the system for what it is, so you can understand what changes actually mean. And once you see it clearly, you cannot unsee it, because the patterns repeat in ways that become impossible to ignore over time. The first thing that changes when cash disappears is not the economy itself, but the way individuals experience control over their own money in daily life. Cash provides a sense of independence because it exists outside of systems that require permission, validation, or technological access to function properly. When that independence is removed, every transaction becomes dependent on an external network that must approve, process, and complete the exchange. This introduces a layer of control that did not exist in the same way before, even if it is not immediately visible to most people. Because now your ability to spend is no longer entirely yours. It is mediated through systems that can be adjusted, monitored, or restricted if necessary. At first, this feels like convenience rather than limitation, because digital systems are faster and easier to use in everyday situations. But convenience often masks dependency, and dependency becomes clear only when something in the system stops working as expected. A simple delay in processing, a network outage, or a system restriction suddenly becomes more than an inconvenience. It becomes a barrier between you and your own money, and that barrier introduces uncertainty, something that did not exist when transactions could happen directly through physical exchange. This is how control shifts, not through force, but through reliance on systems that operate beyond your direct reach. The second change happens at the level of visibility, where every transaction you make becomes part of a recorded and traceable system. Cash transactions are private by nature. They do not leave a digital record that can be analyzed or tracked over time. When cash disappears, that privacy is replaced with complete transparency within the financial system. Every purchase, every transfer, every movement of money becomes data that can be stored, reviewed, and interpreted. This data has value, not just for security or efficiency, but for understanding behavior at a large scale. Because once patterns are visible, they can be influenced, predicted, and in some cases controlled indirectly. This does not require direct intervention. It works through incentives, restrictions, and subtle adjustments to how systems operate. And over time, these adjustments begin to shape how people behave financially without them fully realizing it. Spending habits change, decisions become more calculated, and behavior aligns with what the system allows or encourages. This is how visibility becomes influence, not through direct control, but through structured guidance of behavior. The third shift is structural, affecting how money exists within the system rather than how it is used by individuals. When money is entirely digital, it no longer exists independently. It exists only within accounts managed by institutions. This means access to money is no longer direct. It is conditional based on the rules and policies of the system that holds it. These rules can change, sometimes gradually, sometimes suddenly, depending on economic conditions or policy decisions. Limits can be introduced on withdrawals, restrictions can be placed on transactions, and access can be modified based on external factors. This level of control is not always used, but its existence changes the nature of money itself. Because money is no longer something you hold. It is something you are allowed to access under certain conditions. This creates a fundamental shift in how financial security is perceived and experienced over time. You may have the same balance, but your control over it is no longer absolute, and that difference becomes critical during times of instability. The fourth change is resilience, or more specifically, the reduction of it within the system. Cash systems are simple. They do not depend on electricity, networks, or centralized infrastructure to function. Digital systems, on the other hand, rely on multiple layers of technology that must operate continuously without failure. If any part of that system fails, transactions can be delayed or stopped entirely until the issue is resolved. This introduces a new type of risk, one that is not financial in the traditional sense, but operational, because the ability to use money becomes dependent on the stability of systems that are not always within anyone's control. A technical failure, a cyber issue, or a large-scale disruption can interrupt the flow of money instantly. And when money stops moving, economic activity slows down with it, affecting everything from small purchases to large transactions. This is not a collapse, but it is a disruption that reveals how dependent the system has become, and that dependency grows stronger as cash disappears completely. The final shift is behavioral, where people gradually adapt to the new structure without fully recognizing how much has changed. At first, the transition feels unusual, but over time it becomes normal as habits adjust to match the system. People begin to rely entirely on digital methods, and the idea of cash starts to feel outdated or unnecessary. This shift happens slowly, not through enforcement, but through convenience and repetition. And once the behavior changes, the system becomes self-reinforcing because there is no longer a reason to return to the old model. This is how transitions become permanent, not because they are forced, but because they become accepted. And when acceptance is complete, the underlying changes are rarely questioned anymore. That is when the system has fully shifted, not just in structure, but in perception. And perception, more than anything else, determines how people interact with money over time. Because once something feels normal, it becomes very difficult to see it as anything else. Once the system fully transitions away from cash, the most important change is not visible in transactions, but in how power is distributed within the financial structure itself over time. Because when money exists only inside a controlled network, the authority over that network becomes more significant than the money it holds. This means the question is no longer how much money you have, but how much control you actually have over using that money. And that difference becomes critical during moments when the system experiences stress, instability, or sudden policy changes. In stable conditions, this structure feels efficient and even beneficial, because transactions are faster and processes are simplified. But stability is not permanent, and every financial system eventually faces periods where pressure begins to expose its underlying weaknesses. When that happens, the same systems that provide convenience during normal times begin to impose limitations that were previously invisible. This is not a malfunction, it is the system operating exactly as designed under different conditions. And understanding that difference is what separates expectation from reality in financial environments that are constantly evolving. Because what feels like access in one moment can quickly become restriction in another without any physical change in the money itself. One of the most significant consequences of a cashless system is the ability to implement direct policy changes at the individual level. In traditional systems, controlling money required indirect tools such as interest rates, taxation, or broad economic policies. But in a fully digital system, changes can be applied directly to accounts, transactions, and spending behavior in real time. This means policies can be targeted, adjusted, and enforced with a level of precision that was not possible before. For example, spending limits can be introduced on specific categories, restricting how money is used. Access to funds can be delayed or staged, controlling when and how money becomes available for use. In extreme cases, negative interest rates can be applied directly, reducing balances over time to encourage spending. These mechanisms are not theoretical. They have been discussed and partially implemented in different economic environments. And while they are often introduced gradually, their impact becomes more noticeable over longer periods of time, because they change not just how money is used, but how people think about holding and managing it in the first place. Another important effect is the erosion of financial privacy. which changes the relationship between individuals and the system. Privacy in financial transactions is not only about secrecy, it is about autonomy and the ability to make decisions without observation. When every transaction is recorded, that autonomy is reduced, even if no immediate action is taken based on that information, because the knowledge that behavior is being tracked influences behavior itself in subtle but consistent ways. People begin to align their actions with what they believe is acceptable or expected within the system. This creates a form of indirect control that does not require explicit rules to be effective. Over time, this alignment becomes habitual, and financial behavior becomes more predictable and easier to manage at scale. This predictability benefits the system because it reduces uncertainty and increases efficiency in how money flows. But for individuals, it reduces the range of behavior that feels comfortable or safe to engage in. And that shift happens gradually, making it difficult to identify as it unfolds. The next layer of impact is economic inequality, which can be amplified in systems where access is mediated by technology. Not everyone interacts with digital systems in the same way, and differences in access and resources create uneven experiences. People who are more familiar with digital systems adapt quickly and maintain access to their financial resources without disruption. Others may struggle with technology, connectivity, or system requirements, creating barriers that did not exist in a cash-based environment. These barriers are not always intentional, but they produce real consequences in how money can be used and accessed. Over time, these differences can widen the gap between individuals who can fully participate in the system and those who cannot. This creates a layered financial environment where access is not equal, even if the rules appear the same on the surface. And once those layers are established, they tend to persist and expand as the system evolves further. Because systems naturally optimize for efficiency, not for equal accessibility across all participants, and that optimization process often leaves certain groups behind without direct intervention. Another critical effect is the reduction of informal economic activity, which plays a significant role in many economies. Cash enables transactions that are small, local, and outside formal systems, providing flexibility. When cash disappears, these transactions become more difficult, forcing them into formal channels. This increases regulation and visibility, but it also reduces flexibility and adaptability at the local level. Small businesses that rely on informal transactions may struggle to adjust to the new structure. Individuals who depend on cash-based income may find themselves excluded from the system entirely. This transition can disrupt existing economic relationships that are not easily replaced by digital alternatives. And while the system may become more organized, it may also lose some of its resilience and adaptability. Because informal systems often act as buffers during times of economic stress, removing them entirely changes how economies respond to shocks and disruptions. The final realization is that a cashless system does not remove risk, it redistributes it in ways that are more centralized. Instead of risk being spread across physical assets, it becomes concentrated within systems that manage digital money. This concentration makes the system more efficient during stable periods but more sensitive during disruptions. Because when a centralized system experiences a failure, the impact is widespread and immediate. There is no alternative method to fall back on, no parallel system operating independently. This creates a situation where stability depends entirely on the reliability of a single structure. Understanding this means recognizing how it changes the nature of financial risk. Because the form of money may evolve, but the underlying dynamics of control, access, and dependency remain constant. The question is not whether cash disappears, but what replaces it and how that replacement reshapes everything around it.